And I'm a senior fellow here at the Peterson Institute. And on behalf of the president of the Institute, Adam Posen, it's a great pleasure for me today to welcome Minister Michele Geraci from Italy, the Undersecretary for Economic Development. I believe that is the correct title. I found actually several, but I think that is the one. Very good. And Minister Geraci has today gracefully graced us with his presence to talk about globalization, the international trading system from a particularly Italian point of view. Minister Geraci comes to his new office, I think it's fair to say, as a little bit of a Renaissance man, since he certainly has a very diverse background. And he has very long-standing ties to the United States as well. He has close family connections to the country. He studied at MIT for his MBA in Boston. But before becoming a minister, he spent close to a decade in China, holding, among other things, the position of head of China policy at the University of Nottingham Business School. But Minister Geraci is also affiliated with numerous other universities, including NYU in New York, Shanghai Xinjiang University, and as a Dane, I was pleased to know that he has also taught at the Copenhagen Business School, which gives us at least, which means that since I have actually taught a class or two, not a course, but a class or two there, gives us something in common. He also has a varied background in business. He was an investment banker focusing on the telecommunications area, and he is the recipient of the Knight Order of the Star of Italy from President Mattarella. So, Mr. Minister, we look forward to your remarks today, after which we will ascend to the podium for a brief talk, and then we will open it up for questions from the audience. The floor is yours.
Good morning, everyone. Very, very happy to be here. It is me who have to thank you for kindly inviting us to be here today and give us the opportunity to share with you some thoughts, some issues that we in the new government have been working on since appointment in June. Over the last 6 months, we have, of course, focused on forming the team that will run Italy for the next few years. And we are starting to take what I think is relatively speaking, a new approach to politics. My presence in the government should give some hints that the government in Italy is now more serious to take a more analytical, fact-based approach, less ideological. I'm not a member of the parliament. I basically brought no votes whatsoever to the current parties. And me and some other like me with experience in the business world have been called to, let's say, fill the gap in the government team. We want to stay a little bit away from ideology and refocus back on facts, analysis, numbers. And so one of the first things that we did was to re-examine all the current future free trade agreements that European Union has with the rest of the world. And really, rather than just saying, oh, free trade works, trade is good, trade benefits both parties, we then try to see, well, by how much? By how much does trade benefit parties? And so we are trying to now develop within the government, you can imagine the first time ever, some global equilibrium models, computable global equilibrium models, something that people have never heard about in the politics circles, to try to estimate the key gain or losses from trade. And so we're looking at the trade agreement with Canada, the CETA, Vietnam, coming up Mercosur, Japan, Korea, and of course we're looking at how we can improve the trade relationship with the United States. So this is a more new approach. Now, once we do see the numbers, we have initial findings that suggest that, of course, trade contributes to average increase in GDP. However, we are beginning to find that within this average, if we open it up, creation of new job is positive, GDP growth is positive, but within this plus sign, there are very high plus and very low minuses. And so the average hides a diversion of outcomes. And when we do face that, we do not have in place a redistribution mechanism of redistribution of income that compensate the losers. In my view, trade is a Darwinian approach. It does increase the average quality of the members involved, but it does leave behind the giraffes whose neck is not tall enough to reach the leaves at the top of the trees. And so the society needs then to decide, do we take care of those weak, vulnerable segments of the society, or do we let the free market forces adjust? Now, the Italy that I found, after having been away for 30 years, is a country that quite does not know how to deal with those weak part of the population. I've left China, where I lived for 10 years, and I got back to a G7 country that has the same poverty ratio as China. 10% people below poverty line in Italy, 5 million people, more or less. This is, for me, is something not acceptable. There is also a way of thinking in many young people that do not really push them to put themselves in play and go find new opportunities. Flexibility of the job market is not at best. People's way of thinking is not very flexible. And so we are finding in a difficult position to try to, on one hand, stimulate trade, and we want to trade. Italy GDP comes from export. Up to one third of the economy comes from export. So indeed, we do care about trade. We are a large manufacturing power. We have lots of small, medium enterprises that trade. And on one hand, we want to expand this number of companies trading. We want to expand, increase the intensity of these companies selling. So we want to increase the number of revenue per company that exports. And so we are indeed pro-market, pro-trade. But we also, on the one hand, we need to find ways to fix those 5 million people and the others that are left behind. And so one of the few things that we are finding in Italy is that in the job market, demand and supply do not meet easily. It's almost as having two curves that do not cross, and this leads to young people not finding jobs and company not finding people. So we are trying to fix this by acting on making demand and the supply curve shift closer to each other. On the job supply side, we are introducing universal basic income, which in our philosophy is not a subsidy for the lazy. We do not let people sit on the couch all day with 800 euros in the pockets watching TV. We do not give them cash. We give them a card that can only be spent on certain goods, and we decide what these goods are based on like a pyramid of needs: housing, food, and then hopefully training, so that these young people can actually spend a part of the amount that they receive every month into something that helps them bring into the job market. So this universal basic income is not free money. There are very tight conditions attached to it so that those young people can actually train themselves, and they are obliged to spend a minimum number of hours learning. They are obliged to work in companies as trainees as needed, and they cannot refuse more than 2 job offers. After that, they would lose this allowance. So we try to design it, and we welcome the input from all of you here. That's also why we're here, so that we can make sure that this money is spent. Because when the money is spent, the multiplier is at least 1. And so we spend, to make it round numbers, 10 billion euros on this plan. And because people cannot save it, because it's not cash. They cannot put in the bank account. They need to spend it. We are even thinking a system of that, just like the mobile minutes, they do not roll over into the next month. So if you don't spend it, you lose it. And so all this money will go back into the economy. So $1 spent is immediately $1 addition in consumption. And even forgetting the infinite series of the marginal propensity to consume that will give us a multiplier closer to 2, even with a multiplier of $1 spent, $1 coming in consumption, because in Italy we have a debt to GDP higher than 100%, 1 and 1 decreases the debt ratio, because 131 divided by 100 is less than 130 divided by 100. And so if we increase the debt by 1 and GDP by 1, the debt to GDP ratio goes down. So this is one of the nice things of having high debt levels, one of the few advantages. Countries that are more virtuous than us, they have less than 100%, cannot really fix that. So that's why they don't get it, why we spend money, because every money we spend, it's gold coming back in. And again, this is even if you assume a very conservative multiplier of 1. Which leads me to another hot topics that we have discussed with the European Union. Do we grow by 1.5%? Do we grow by 1%? 1.5? Big debate. Do we reach or breach 2.4? In my view, I was a financial analyst, so we used to forecast the future. I think your compatriot Niels Bohr, the Danish quantum physicist, said prediction is always difficult, especially if it deals with the future. And so I think he didn't mean as a joke, because he was a quantum physicist, so he was actually contemplating the possibility of going back in time. So I think he did really mean about the future is hard, about the past is easier. But because it's about forecast, we don't need to argue. It's like a company forecast. We will know what the GDP is going to be in Italy for the year 2019 by the summer. So come August, July, we will observe the denominator, the GDP, for the first 6 months. And so we have a very clear view of what this is going to be for the full year. And then the expenditure, the capital expenditure, which is all backloaded in the second half of the year, is discretionary. And so we have the luxury to first observe the denominator for the full year, the GDP, and then we can decide what is it that we can spend so that the ratio does not exceed 2.4. So whether people say, no, you will exceed it because GDP is going to be lower, it's like a non-discussion for me. It's like a non-issue, because if the GDP is indeed 1%, then we will spend less. And we can do this in 2 ways. One, by delaying the beginning of certain programs, so that on an annualized basis, we spend less for 2019, and so we keep, in any case, the expenditure divided by GDP below this 2.4, or we can make the intensity of these plans less intense. So we have timing and intensity levers that we can play with, so that come August, come the summer, we observe what the GDP is going to be for the full year, and then we will decide how much we can afford to spend, so that we never cross the 2.4, which is, again, the absolute limit. So in my view, many of these issues of do we waste money on universal basic income, I think we cannot almost mathematically waste time. Remember, Italy is the only country in the world, almost the only, that for almost 25 years, every single year almost, has had a primary surplus. In other words, Italy is the most virtuous country in the world at managing its public finances. Government revenue is it's more than government expenditure, and this has been so since 1992, with one exception in 2009. No other country, no other big country, I think Norway or Malta may have something similar, no other country, maybe Denmark, I don't know, no. No other country really has had this very long history of primary surplus. And so the only reason why we are negative is because we have a relatively high cost of servicing the debt. And the reason why the cost of servicing the debt is high is because people think we may have difficulty in lowering the ratio. And they think we have difficulty in lowering the ratio because we're spending money on universal basic income. But I'm saying, no, the more money we spend on universal basic income, the more the ratio goes down. And if people just flip the thinking that and refocus, I would say, on the real economy, the primary surplus, and they put the finance part on top, the cost of interest, almost as if a company, you analyze a company above or below the EBIT line before or after interest expenses. The sustainability of the country economy, in my view, relies mostly on the primary surplus analysis, because that's what you cannot really change so much. It's more of a structural thing. The cost of interest is, of course, a function of what people believe about it. The last thing I want to say, and then we open for more Q&A, is that we do have an inflow of M&A coming to Italy. People say there is outflow of capital. People do not trust the government, they don't trust the economy. But indeed, we do have, in fact, money coming in on M&A that we do not always welcome. Over the last few weeks, we have had M&A into Italy. We have sold fashion brand Versace. This has gone now to foreign shareholders. We have sold Italian white goods manufacturer Candy to Chinese Haier. We have sold Magneti Marelli. In the past, we have had M&A on Pirelli. So if anything, I am, like most people, worried about predatory M&A, because we do not want our core assets to fall into hands that do not always create value for our economy. And so the last leg of our government plan on M&A, inbound M&A, is that to make sure that as much as possible, we divert or encourage investment into greenfield instead of M&A. Or if there is M&A, we then do encourage capital increase and the primary issue, so that the target company is not only bought, so there is not just a secondary equity transaction between the old and new shareholder, but also new money coming into the company. And the condition that I have considered always is, does this transaction create value? Does this transaction create a GDP growth? Does it create employment? And does it allow a better market access to the products of the target company? If those conditions are met, then I'm quite happy to do that. Otherwise, we block it. And so even we in Italy, we are discussing a screening mechanism against predatory M&A, and we will develop in the next few weeks. So this is just a general view, and I want to maybe stop here because I want to leave it to Q&A. These are just general pointers for the discussion of today. Thank you very much, and look forward to your tough question, frank and open. Thank you very much.
Force of a very long list of issues, not just, I might add, the trade and investment issues that we had advertised this event for. So maybe I can start by picking up on one of the other subjects that you mentioned that is very dear to my heart, and then I will divert us back to the original topics. Your description of the universal basic income program that your government is implementing, which essentially you described as a non-cash, basically heavily conditional program that in principle could be linked directly to the requirement to take up job offers as well as training. At least in the way I think the traditional economics literature describes the universal basic income program, that is not a universal basic income program. It is in fact something that looks much more like something that me as a Dane recognizes as essentially close to a flexicurity program, where you link basically benefits to the the picking up of training and acceptance of job offers. And I think, and even if you were to put things slightly on the edge, you would say that this is not very dissimilar to elements of the German Hartz reforms. So I guess I would suggest, in terms of having other European countries, if I might say so, look at these proposals with an open mind, maybe relabeling them.
It's a good question. We cannot relabel because that's what we said in campaign, so we have to keep the name. But we're changing the substance. And you're right, we need to make a very big effort in communicating that within this name, universal basic income, what lies underneath is really a different thing, which is conditional. That's the key word, because universal basic income is normally associated with unconditional money. We saw the experiments in Finland, in Alaska, and some other places. Even in Brazil, there were some elements of that with the Bolsa Família and other, but we indeed do keep this very conditional. And it is has two goals that I did mention. One is truly poverty alleviation. So if you look at the pyramid of needs, where at the bottom where you have food and shelter, there would be money, and there will be a large part of the population that will just get the money to be able to survive. And then there will be a second layer of people that will get the money to get into the training programs. The other philosophical aspect, if I may, is that because of this high trade intensity that Italy has, because of this very high, intense competition that we may face with China, you know, Italy and China have a very high degree of overlaps in terms of goods produced. So the similarity degree is very high. So basically China makes the same thing that Italy makes. And Italy has the highest degree of similarity with Chinese goods out of the all 28 European countries. However, China has the scale against which we find it hard to compete. And so the only way that we in Italy, big manufacturing country, can compete with a country that makes half of what's made around the world and 20, 30 times more than we make with the obvious lower average cost, is to focus on the soft part of the production. In Italy, we do high quality manufacturing, not because there are good engineers only, but because the engineers wake up in the morning and they see art, they get inspiration from the culture, the history, everything that surrounds the Italian system does help even people that do industrial design, even people that do machine utensil. And so this, another leg of the philosophy behind this universal basic income is also to allow people to do jobs that may immediately not lead to salaries like engineering and finance. We want to make sure that people do not all flock into these sectors just because it's easy money, but we want to continue what I call it, you mentioned Renaissance, the true Renaissance of Italy. You know, we've been living off things that we've done 500 years ago. And it's kind of time to upgrade the system. And we want to redo a new Renaissance, mixing the hardware, manufacturing, with the software. And so the government needs to, just like popes and kings used to finance artists that would make paintings that were immediately not monetizable, but they did help the whole Renaissance of Italy engineering. We try to do something similar. And so let people say, if you want to be a painter, be a painter. Do not worry, because your input to the society goes beyond your painting. Hard to
implement, but
easy to implement, because we have the money to do it.
Very good.
For the time being.
And then if I could pivot back to where you left off, which was the issue of M&A, foreign direct investment, openness, etc. I mean, it's obviously the case that
you're not coming through.
On, I should be. All right. Well, I guess I will have to speak up a little bit then. On the issue of M&A that you mentioned, it's no secret that the European Union recently, as you also mentioned, have agreed a new potential framework for investment screening. You mentioned the Italian government's new criteria against predatory M&A. But there was one element missing in that, and obviously that's an element that is often of key concern here in Washington, namely the issue of national security. Is that an issue that the Italian government also wishes to include in its national investment screening? And since you have close ties to China, it's obviously no secret that many of the concerns in this country and other countries, in other EU countries, concerns China.
Indeed, and because I've lived there, I'm probably more concerned than you guys here about China and any other country that may do predatory M&A. So, to be clear, we want to limit predatory M&A. We are very much concerned about national security, and so we want to do a screening mechanism that indeed prevents those kind of activities. The current European Union proposal that we have softly opposed does not do that. The current proposal by the European Commission is not a screening mechanism. It's called, just like a universal basic income screening mechanism, but inside there is no mechanism and there is no screening. The current proposal is only an information sharing framework. To make it simple, what the current proposal on screening says is that if France receives a bid from a non-EU M&A, they would have to disclose this information to the rest of the other 27 parties. And so every other country should do it. That's it. Now, to me, this has no characteristic of blocking, of screening, or analyzing it. And so what I want to do is something that really does that. The reason why I don't like this proposal is many ways. One, of course, it doesn't do the screening. Two, as a former banker, I know that when a company is in play, so if you announce, I don't know, Telecom Italia has received a bid from some foreign company, the next thing that happens is the opposite of screening. It's everyone flocks to that target. So if anything, the disclosure of a potential bid attracts more bids or more interest. So it has the opposite effect. The second thing why I don't like it is the way the European Union works is that once something is agreed, like there is a regulation, the issue is put to bed. So if we approve this regulation that doesn't do that, no one will, for the next 2 years, focus again on the content of this regulation. A regulation that does not make any prevention from incoming M&A. So we will be, my fear is that if we approve this regulation as it is, we think we have solved the problem. We will fall under the illusion that the problem is solved. And then for 2 years, no one will worry about it because we have election in May, then we have the change in the commission. Nothing will happen until 2020. And by then, we could wake up to realize that there has been indeed a flow of incoming M&As that we have not been able to prevent, analyze, monitor, screen, because the regulation that we have signed does not do that. And so if I want to just make a quick statement, it's not that I don't want to support it because I'm against the screening mechanism. I don't give my strong support to the current proposal because it's not enough, it's weak. I want to have a stronger mechanism. I want to have something real. And this really not only doesn't do it, but has negative components.
Well, I think now maybe it's time to open up for questions from the audience. We have until 9:30, which is a little earlier than the originally advertised, but due to the minister's schedule, we'll have to close it at 9:30. So if we have a traveling mic, and there are obviously a standing mic here, if anybody wishes to ask questions, please, the floor is open.
Hi, Hannah Monikin. I'm with Inside U.S. Trade. I was just curious to hear your perspective from the Italian perspective on kind of U.S.-EU work on a potential trade deal and what you foresee, what you would like to see in that, and what you think can be done with that, with what's happening.
Thank you very much. So, you know, the US, especially for us, for Italy, is a very important trade partner. Half of the total Italian trade surplus comes from the US. So the US accounts for 25 billion euros out of the 50 billion euros that we have in terms of trade surplus. So there is no question, but I do re-emphasize that US is a very important partner, and we want to get the relationship even closer. From my point of view, I'm not, although we have a trade surplus, I care more about the sum of import and export, not the difference. So I'm more focused on the improving terms of trade for both parties, not just the trade surplus, because we do know that even buying things does add the value to our economy. We have you know, situation where U.S. average tariff, weighted or unweighted, MFN or no, around 3%. European tariff is about 5%. So we are a little bit higher. It's not a lot. We have rooms to decrease it. We hope that the U.S. does, for example, do not impose tariff on auto parts, for example. This is something that concerns us because Italy does make a lot of components for example, for German cars. So even if there is some friction on the export of German cars into the US, the one that would pay the higher price is also Italian company that supply at least 40% of the value to German manufacturer. So we have no intention to escalate by all means. In fact, we want to relax the situation on all trade partners. We in fact have proposed to allow more of our Italian agricultural product to enter the United States. You know, we have a very good safety standard. I think Italian food is kind of welcome around the world. It is complementary to US products. It's not substitutes, so it would not compete directly. So I think these are, you know, rooms that we, you know, things that we can do to improve it. But again, we already have a very, very good terms. So we are in no critical situation with some those, you know, point exception that I think will die out hopefully very soon.
Peter Rashers from AICGS at Johns Hopkins. I wanted to ask you what you think about the European Commission's proposals for WTO reform, and in particular, whether you're optimistic that the United States and the EU can agree on those proposals.
Thank you very much. On the WTO reforms, I think the thing that we need to address even at the EU level is how to deal with a country, China, for which the WTO was not designed for. Like, you know, when we designed mid-90s, no one well, maybe not many, we should have expected that there would be soon a country that makes half of what's made around the world. Now, when I talk to my Chinese friends and we argue about market status economy, we give it, we do not to China, and the WTO rules, you know, international prices, domestic price, what's the reference price to use for anti-dumping? They say, well, Michele, no, we are the international price, not you. Because we make things and we make half of what we make. The reason why international prices are higher than Chinese prices is because you don't have scale. So because you are inefficient. This is the Chinese guys talking, not me. They say our domestic price is low, not because we do subsidies, but because we have scale. Now, the WTO does not deal with it. I mean, it gets into very locked situation because, of course, they would be state aids, subsidies into Chinese manufacturing that load, you know, monetary. I've always argued that there is monetary dumping, and people don't talk very much. You know, very, very low interest rate in China. Interest rate in China have been at about 5% for the last 20 years on average, and this is very, very low number because the GDP, nominal GDP, has indeed grown by 14, 15% nominal for many years. And the gap between GDP nominal growth and interest rate is, in a way, the level of subsidy that the government does to export company or company that borrow, because they borrow at a rate which is cheaper than the growth rate. You know, in Europe, we have zero growth, zero rate. The US was like this. In China, was 15 GDP, 5% nominal interest rate. So monetary dumping has been one of the things that I witnessed to be really very important for lowering the average prices. It's not just the standard living condition of workers, wages, there's also cost of interest that has been done. Now, the The question is, even without all these aids, China still makes half of what the world buys. And so the question, and I don't know the answer, is in terms of how do we reform this multilateral trading system, is even if all terms of trade turn into fair trade, what do we do to compete with scale, especially in certain manufacturing areas? My small answer was the getting people back to Renaissance. So not compete on hardware, compete on software against strong manufacturing powers. And so maybe more on services. So the way I would see the WTO reform is to fix and think of goods and services trade not as two separate things, as it has been done before, but to put them together, because now with all the, I don't need to tell you, the internet and so on, things get very clouded and muddy. So one thing I would add is to put those two together, and that would give us also a weapon to manage potential cost differentials with other trading partners. But the proposal, I tell you, is far away from it. Like very, very far from having those issues being included.
Thank you, Mr. Minister. Two questions, if I may. Doug Redeker, International Capital Strategies and Brookings. First one, you mentioned the 2.4% budget deficit target and the mechanism to keep it below that. But I would assume the Commission would have an issue with that 2.4 as a starting point. So first question is, how do you see the commitments made by the previous government in connection with the current government's moving forward? Because the previous government's commitments were part of the reason why the Commission did not implement some excessive debt procedures in the past. Second question, as a country that does have an automobile manufacturing industry, and I don't mean this to be flip, but in the context of potential auto tariffs being issued by this government, the Trump administration, the premise for that would be that foreign autos would be declared national security threats. How would you respond if that finding is actually made by the Commerce Department as a predicate for the U.S. imposing tariffs on foreign autos?
Thank you very much. The 2.4 issue, I think if we stay below 2.4, because we emphasize that the 2.4 is the absolute maximum, so we will not cross it. I think the Commission does not have a problem with 2.4. The Commission has a problem with the fact that the 2.4 is A divided by B, and B in my model is 1.5. The Commission says, you know, it's not 1.5, it's 1. So your 2.4 is really 2.9. And I respond in the way that I did before, say, we will watch it. Whatever it is, we'll observe it. I think that if we stay at 2.2, which is I have to give you a secret, less than 2.4, then people would not complain so much. You know, a G7 country with 1.7 trillion economy will neither go bankrupt nor will resurrect if you spend 5 billion, 3 billion more or less on your budget. So the issue, you know, I think is more personality. It's more politics than economics. It's the approach that the Italian new government we have had with the European Union, maybe a little bit to confrontation. The old government was not. By the way, the old government you mentioned, I don't like to talk about other governments because it's not like, but let's say in previous budget laws, the plan was always below agreement with the EU. So the budget law that the previous Italian government have pushed was never in breach of European rules. The promises. The reality was different. So what happened in the past? You kept the narrative down. You said, I will behave, and then you go over. Here, we're choosing another strategy. We say, we don't need to kind of fake the future. We tell you exactly what we think we're going to do. And we stick to that. So if you look at all these charts that you probably have seen around, the previous budget laws with their promises, they've always been broken for the last 10 years. Naturally, because they were a little bit too tight. We need to work on the narrative on why we spending the money. I will mention we have another investment leg of the market that we have 15 billion extra euros being spent on investment. And you know, again, 1 for 1, you spend 1, you get 1 on GDP. So 15 billion for 3 years is 5 billion per year. 5 billion is already 0.3, 0.4 of the GDP. So that already clears the difference between the 2.4 and the 2 that the European Union would like to have. So on the budget, I tell you, I'm very, as I said, I don't think it's an issue, also because now the issue is put to bed. I said, like the European Union, a lot of noise in October, November, and now nothing will happen. You know, Moody's have done their stabilized outlook, Standard & Poor's, you know, all the ratings have now stabilized. The yields on Italian government bond has gone down a little bit in the last few weeks. Everything is priced in, and so there is no negative surprise in my view in terms of what could happen in terms of the relation between EU and Italy. And so by the time we see the numbers in the summer, I think either we or someone else will be right, but in any case, we will stick to the deficit target of 2.4. The other question is on cars. You know, I give you a very quick answer. We wait and see. So we have to wait and see what the administration will do in these regards. I think there are signs that maybe something could soften, but it would not be good. I tell you, but we you know, we will see when this comes how we will react.
One important element that ties into what Doug just mentioned, which is this sort of linkage of national security concerns and trade, is an element we haven't touched upon yet, which is the use of economic sanctions, trade sanctions, where obviously right now we have an unfolding crisis, if you like, or at least confrontation between the EU and the United States over sanctions on Iran. But I think, you know, there are other economic sanctions scenarios out there, frequently one that involves also Russia. I mean, there's talk about a European equivalent of the Magnitsky Act, which you could basically say is sort of an automatic imposition of sanctions on certain type of human rights and other violations. What is your government's view and your view on this set of issues?
I tell you, I'll give you a quick answer to this. This falls, and I'm very honest, into the decision of a Minister of Foreign Affairs, which is more and less on trade. And maybe you'll be surprised, we try even in the Italian government to have an approach that everyone does their own job. Before, maybe in the past you've heard people talking about other things. This is a very much a geopolitical issue. Me, as a trade undersecretary, I try to sell more olive oil and oranges to our partners around the world. I do not set you know, foreign policy for the government, and so I pass this question as I have to. Thanks.
All right. Well, I tried.
Try.
The other element that you, in your initial remarks, you mentioned the sort of inevitability of new trade arrangements creating winners and losers. And obviously that then there needs to be a government response to hopefully have some transfers between the two. And you know, if we look at the political support for trade in this country, I think it's fair to say that the United States has been quite poor at that. And I guess in a European context, my question to you is that given that it's the EU that negotiates trade agreements, but that the types of redistributive efforts that should accommodate winners and losers are overwhelmingly, you know, at the member state level. I mean, there is a fund for globalization at the EU level, etc., but it is not something that is directly part of the existing EU budget framework. Should it be?
It is, and in fact, we are trying. One of the things that we discussed with Ms. Malmström a few weeks ago was to try to make this. The European has a globalization fund, like you mentioned, aimed at redistribute income for the losers. Now, who are the losers? The big company or the small companies? Small companies. The European Globalization Fund has a amount of 150 million. And it can only be used if a company fires more than 500 people. Now, to me, this is a completely something that does not help the one that I want to help. I want to help the small guys. I want to help the companies, not just the Italian, but all the European companies, the SMEs that gets wiped out by this wind of globalization. They are companies with 10, 15 people. This globalization fund is aimed at the other guys, the guys who fire 500 people. We don't care. So one thing that we want to do at European level is to make sure that this globalization fund, which again is a name, the name should be changed. It's the, should be called the anti-global. I mean, it's like the fund against the negative effect of globalization. Should be A, bigger, not 150 million, which is pocket change. 2, not done for companies that fire more than 500 people. A company that fire 10 people or less, and they have a size not exceeding 15, 20 people. So it needs to be redesigned. And I think whilst member states, they may do their own redistribution, I think it is good, it's a duty, and also good for the Europe as a whole to play both legs of its role as the center of trade agreement. If Brussels does a trade agreement, it is Brussels that should do fund to compensate. And I think in a way that would increase the perception the citizens have about the European Commission, the European Union. And it would be a positive development in getting the citizen back in touch with this, because they would see that this money comes again from Brussels, and it's aimed at those that really are left behind. So this is my proposal.
Ted Truman, excuse me, Ted Truman at the Peterson Institute. So I'm going to ask a, in one sense, technical question, also drawn from my many years of experience. Which is, and frustration, I want to say, okay? So in Europe, in general, you measure growth on a year-over-year basis, right? And so that was part of your argument, and during your argument you said, well, by the middle of the year, we'll know what the year-over-year growth in 2019 will be, because we measure everything year-over-year, right? In formerly advanced countries like the United States, we measure things on a fourth quarter basis, or on a quarter comparison basis. So one would, if I were on the other side of the table from Italy, I would say, so you have this argument about 2.4 and 1.5 or whatever, 1 and 1.5. So the real issue is not where you are in July relative to the average for 2018, right? The real issue is where you are in July in terms of your denominator relative to sort of where you're going for the rest of 2019 and into 2020. And the year-over-year calculation doesn't really tell you that. Notwithstanding the fact that I think in most European countries today, I stand to be corrected by Jacob, right? You do put out quarterly GDP numbers, seasonally adjusted, so forth and so on. So you can do, and I guess the IMF does for you, fourth quarter forecast. So one question would be, so could you translate this? My question would be, could you translate the year-over-year conflict, if I may put it that way, into some fourth quarter measure?
I think if it makes it easier, instead of looking at growth rates, we would look at levels of GDP. And I think that would solve the question of growth sequential versus year-on-year growth. So I say growth to make it simple, but it would be the level that we care about, not the growth. So you're right.
Yeah, but you could look in the middle of July, at the middle of the year, you could look at where you are in the middle of 2019 level relative to where you were in the middle of 2018.
I don't even care about 2018, because if my GDP for July is 850 billion, I know that for the full year will be 1.7 trillion.
I understand that part.
I do levels, not growth. Yeah. Am I right in answering your question, or did I?
Well, I don't. Well, all I'm trying to say that if I was on the other side and worry about the trajectory of your fiscal situation, right, relative to GDP, right, I would want to know. I would want to know more about how the trajectory of the denominator as well as the numerator, right, and year over year doesn't do that for you, right? I mean, you want to know something more about where you're going to be end up in the fourth quarter of 2019, if you want to think about that in a level sense. This is probably as much a criticism of the European system. I'm looking at Jacob. He can answer your question for me. my question: the European system, which allows a certain amount of fudging, if you want to put it that way, because of the convention to think about things in year-over-year basis. You can answer that, Jacob?
Well, I mean, you can call it fudging, you can call it flexibility, you can call it plausible deniability. There are many ways to label it. But I think we have time for one more question, if such is the case from the audience. Otherwise, I would like to come back to the initial. Oh, sorry, there is one. Sorry.
Dave Lawler from Axios. Thanks for doing this. So just to clarify something, I think you said in terms of conflict with the European Union that nothing is going to happen and things have largely been resolved, if I've understood that correctly. And I just want to say, does that mean that you don't anticipate further confrontation with the European Commission, penalties? I just wanted to clarify that.
I do expect a lowering down of the tones in the confrontations, a decrease in the frequency of tweets, and an increase in the content. And, once you have an argument, if you start smiling at the counterpart, most times the other guy also smiles back at you. In terms of it's hard. I mean, I cannot do forecasts, of course, on bond markets trends, but I think on the level of the confrontation, everything that needed to happen bad has kind of happened. And in terms of fines, there won't be any fine. This is like, the process for fines, that is something which takes months. And so that's why I say, if and ever there were to be any fines, according to the current expectation of some worst case scenario, it will be after we know the budget and the GDP of 2019. And so the fine in itself would be, again, only in the very rare scenario, still non-zero probability because everything is, that we insist and we go at 3.5% debt, which is, not likely at all. But if we stay within this 2.4, even those fines would immediately vaporize because we would then be within the limit even agreed with the European Union. So I think there is, I think, again, bond markets may have perceived this a little bit because there's been a little bit of an easing on the 10-year government bond. Now, without wanting to say where the bonds would go, I used to teach fixed income and I've dealt with bond markets for a long time. In the past, not in the future, in the past, when people see yields, the bond market will be hungry for anything that goes above zero, as we have seen in the last 10 years of zero interest rates. Bond markets tend to, in a way, get excited in the negative side when there is a risk, but then immediately they can flip, because at the end of the day, the only question that people ask, unlike when you issue and you value stocks, the only question is, do you default or not? And if the answer is no, bond trade at not par or discount, wherever they are, but they would trade at a yield that is a risk-free yield.
Well, on that note, let me say we have reached our witching hour. The minister has, unfortunately, other duties to attend. We would like to have continued. But, Minister Geraci, thank you very much for a very broad and informative set of remarks, and we wish you luck and good fortune in your future travels here and your work in Rome and undoubtedly also in Brussels. And whenever you're in Washington, you're always welcome here back at the Peterson Institute.
Many thanks. Thank you very much. It's been a pleasure. Please, our door is open. Suggestions, views, commentary, do send me an email personally. I will respond. As I said, we're here to tell you what we think, but we're also here in the States to hear your advice. Thank you very much.
Thank you. Meeting adjourned.